Hey, good afternoon, everyone. Thanks so much for giving me your time this afternoon. There's a lot of traders that are just coming in, so I'm just going to give it um, another 60 seconds, and then we're going to start. So just hang tight. All right, good afternoon, everyone. This is Mark from Right Line Trading, and what I'm going to show you today is our full system, our optimized Unorenco trading system. And I think it's going to be, I think it's something that you're going to see is very, very different um, than any software platform you've seen before. And just before I start, I want to read this mandatory disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the Forex futures or stock markets, so for any profits or losses. Our participation in trading in these markets involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Careful consideration of your financial position should be made prior to trading, and those of us here at Right Line Trading are not registered financial advisors, and we're not licensed commodity trading advisors. Now, the way I thought I would show you the platform today is not off of slides. I thought I would show it to you right off of a chart. So there's going to be a lot of information that you're going to get. And I'm going to move to, I didn't trade yesterday because I had to go to Tallahassee to take care of a problem with my son. And let me just show you an area right here. Now, the first thing that I want you to understand is that I do not believe that any indicator that assimilates data from a single time frame has any forward-looking validity. So all of our indicators do a multi-time frame analysis. Number two, you also have to acknowledge that no financial instrument moves in isolation of other financial instruments. That there really is an interlinking or a correlation between different markets. And in many cases, that correlation is extremely tight. And essentially, in the course of the day, what the big institutions and the banks do is simply they rotate their money from asset class to asset class. And it's our job to be able to track the flow of institutional money, because that's the only thing that affects price, is whether people are buying the instrument or people are selling the instrument. And the only time that the market is going to make a predictable and large move is when it's being moved by big money. We don't want to trade when just the commercial traders are trading. We want to get into the market just a step behind the big banks and the big institutions. Another assumption that we make is when big money is not at work, the market by definition, is simply going to move in random chop. And it really mimics any closed system in physics. If you don't put something into a closed system, in physics, it's energy. In the market, it's money. It's simply going to chop. And I always used to wonder, why do markets chop? Um, and that's simply just a fundamental principle of every single closed system of which each financial instrument is. So the market has this tremendous desire to move just in a random, chaotic fashion. And the only thing that brings it into alignment is going to be big money, institutional money and big bank money. And what we want to do is we want to know when that money is at work. And that's when you get the sweet spot to trade, and you're going to get entries that are very low risk with potential very high reward. Now, what I thought I would do is start with the indicators that are the most important that we use. And you may think the system is complex, but it's really quite simple. And with a little bit of screen time and viewing a couple of videos, you're really going to understand it real easily. I mean, it may be a lot when you first take a look at it, but it really isn't that much to it. Now, when I first started trading way back in 2004, I read a book by Alexander Elder. It's called Trading for a Living. And he was the first person to use what's called the triple screen method of trading. Now, when he traded, and he traded himself, I mean, he was a true multimillionaire on trading. You get all these lunatic bogus guys that turn $500 into, $500,000 in a week. He was not like that. This was a guy who really did become exceedingly rich trading back in an era when charting was very, very primitive, really no sophisticated charting methods. But what he did sort of codify was the triple screen method. And what he looked for was an entry alignment. Just excuse me for 1 second. I'm sorry, I'm a single dad. I just have to return a text to my son, who, and it'll take me 1 second. I'm sorry. It's the only thing that would cause me to interrupt this. Okay. So the first and most important thing we look for, doing a triple screen assessment, is a multi-time frame alignment. Excuse me for 1 second. Can you hear me? Okay. Is this the first time, Rory? All right. I had it muted, and I'm sorry. I'm going to start over again. Okay. All right. So the first and most important thing that we look for is a multi-time frame alignment in trend on the market we're trading. And this green background tells us that the NASDAQ is aligned to the upside, not only on our trading chart, but on our 2 higher time frames. It doesn't make any difference what time frame you trade. You can trade a 4-minute, a 5-minute, you can trade a tick, you can trade Renko. I'm trading Unirenko. You're looking for a multi-time frame alignment and trend in the direction you want to trade. Now, in most cases, most software packages, when you see background go green, it's simply because price on your trading chart is rising. And that's something that you already know. The reason background bias is green here is because your two higher time frames have an alignment to the upside. And what that means is that the 50 is green and heading up. These are exponential moving averages. This is green and moving up. The 15 is crossed the 50 to the upside, and price is above it and trending up on your two higher time frames. And you'll see that when background bias is green on your chart, price almost will always trend up. And if I go through the charts, green, price rises. And this background is not using data from your trading chart to make its analysis. It's using the two higher time frames. Here's another area. Now, I'll talk about the clear area in a minute. Here's your pink, which is the strongest downtrend. Down we go, because your two higher time frames are aligned to the downside. Rory? Because your two higher time frames are aligned to the downside. So that's the direction that price is going to move. I'll just show you one more example right here. Now, this is when you want to look for a long entry. Now, this is only giving you a directional bias to trade. It's not giving you an entry. Now, I'm not going to go into as much detail as I can. There are 3 up colors and 3 down colors, and they define differing strengths in the downtrend and the uptrend. There's light pink, there's dark pink, and there's a third color, which you don't see that often. I'll find it somewhere here. Is bisque. And to the upside, you have cyan, blue, and you have the dark green. The sweetest spots to trade are the dark green and the dark pink. That's your perfect alignment to the downside. And it gives you a tremendous edge in trading when you're trading in the direction of the multi-time frame trend. Now, you could do this on your own and set up 3 charts, your trading chart and 2 additional charts for everything that you trade. But it makes it very, very difficult to trade more than one instrument. And in the live trading room that I trade, we trade 3. Now, the second most important component of trading is you want to trade in the direction of your correlative markets. In other words, you want to track the direction of money flow. Now, believe it or not, this background color is really a proxy for money flow, because you're not going to get a multi-time frame alignment and trend to the downside or to the upside unless big money is moving the market. Now, what's important for me to mention is when background bias is clear, like right here, it means your higher time frames have no alignment at all. And it's a very risky time to trade. So if we have no color, we don't trade that market. We leave it alone, because price is almost always going to chop because big institutional money is not involved. The higher time frames are not aligned, and that means your price on your trading chart is just going to move more chaotically. So this defines an area where you're just going to stay away from the market. And if you ask me what's the most important role, how do you become a successful, profitable day trader or swing trader? And if you tell me it's to get winning trades, I would tell you that you're wrong. Your goal is to avoid losing trades. And the real profitable professional day traders don't take losers. They're able to avoid the vast majority of potential losers that appear in a chart on any given day. So what the platform does is make a risk assessment for you. And any trade you take without a background bias giving you a direction is far riskier. So you're going to stay away. And when we don't see background, we don't trade it. It doesn't mean that you can't get a great move. You're not going to get every winner, but we're looking to avoid every loser. That's our goal. Now, the second most important thing that we look for is that we're trading in the direction of our correlative markets. Now, I picked the NQ because it's the easiest one to understand, but you're going to see that we're going to give you 12 templates for 12 markets. Now, these two lines here, what they're doing is they're tracking the multi-time frame trend of the Russell, the E-mini, and the Dow. Now, when you take a long trade on the NASDAQ, wouldn't it be nice to know that the Russell, the E-mini, and the Dow also have a multi-time frame alignment and trend to the upside? It increases the probability that you're going to get a winning trade significantly. Now, in most markets, there's only one line required to assess the correlative markets, and in every market, these are different, which is why every single market has a different template. Here's crude. There's the multi-time frame alignment. Here, there's only one quant line or assessment of correlative markets. The reason we use two on the NASDAQ is because it's so volatile that we want those correlative markets to be aligned on two different time frames. The upper is the fast and the lower is the slow. And when you trade, when both of these are green and background is green, the chances of getting a winner are very, very high. And just to give you an example, to the downside, right here, pink background. So you have your multi-time frame alignment, the NASDAQ, I'm sorry, the Dow, the Russell, and the E-mini are heading down, and there's your short trade. And it's a very low risk trade because you're trading in the same multi-time frame direction as all the other index equities. And remember, all the big institutions and banks do is they look at, risk is on, risk is off. If risk is on, they buy stocks generally across the board. If risk is off, they generally hold off on buying stocks across the board. They move to safer instruments like bonds, notes, precious metals, currencies. So when you get dual reds on a short continuation trade with pink background, you're trading in the multi-time frame direction of the NASDAQ and in the multi-time frame direction of its three correlative markets, the Russell, the Dow, and the E-mini. So it becomes a very, very low risk trade. And it becomes a potentially big runner. And you'll see that this trade went right to support, which is where you would anticipate. It went 13 3/4 points. That's a very big move. And here's where you anticipate price is going to stop, right near support. So I hope what you're seeing is beginning to sort of congeal. Now the dots and the X's above each candle is simply another way of assessing the direction of the correlative markets. Now, if you come aboard, you're gonna get a master class, mentorship class with me, a one-on-one. And I'm gonna go into much more detail as to how these dots and X's make an assessment of the multi-time frame direction of those markets, the E-mini, the Dow, and the Russell. But we do a dual analysis because you want to take an entry on dual dots, again, to confirm that the correlative markets are moving in your direction, as well as the analysis that these two lines do. They're looking at the same markets, they're just doing a little bit of a different analysis. I call this a 4-quadrant analysis. This is just a trend analysis. Now, the other thing that we look at, and remember, everything that we look at is there to decrease the risk of taking a loser. It tells you when you've got to stand down and when you've got a very low risk, potentially high reward entry. And if you'll notice on this candle, the halo is magenta. Now the halo, color and thickness are determined by you, and it's order flow. If you want the down that outline to be red, it can be red. If you want this to be green, it can be green. Thickness is also can be changed just by right here. You see the candle outline? I have it at 3-point. You can change it to 4-point. You can change the wick. So you can change the thickness and the color. And what we do, it's the most complex analysis we do. But what we do is a market delta analysis of each candle on the higher time frames. Put that in a 15-period moving average. And when the two 15-period moving averages are sloping down, it tells you there's significant selling pressure. When those two 15-period moving averages are sloping up, it tells you there's significant buying pressure. It's the most difficult assessment we have to work with. And I would go into that in greater detail in that master class. But it's really important that you take an entry with order flow in your direction, because it helps guarantee the continuation of the trade in your direction. Now, and I'm really kind of moving through this fairly rapidly, we also need a momentum assessment. Now, almost every momentum assessment, you can use a lot of indicators to look at momentum, including the MACD. We just happen to, what I like the most is an oscillator. Now there's a whole bunch. There's RSI, there's stochastic, if I spelled it right. There's Williams. There's Williams K, and there's more. But let me make it really clear what these are meant to do. And I spelled it wrong, but don't worry about that. As long as you know that means stochastic. They are meant to find divergence signals for you to trade. And trading divergence is going to kill you. It works sometimes, doesn't work other times. There's no way for you to make a risk assessment on the entry. And therefore, in my, the way I trade, it is just simply not usable. I need to be able to know in my head what the general probability is of getting a win. I need to make a risk assessment on the entry. Now, let me tell you why divergence no longer works. Let me tell you why a whole bunch of other things no longer work either. First of all, these used to be really important. Elliott wave, Gann theory, Japanese candlesticks, and divergence. The reason they don't work anymore, and I'm telling you they don't, Japanese candlesticks are helpful, but the power that they used to have is weakened. And I spelled divergence wrong, but hopefully you can read typo and understand what I mean. Is that they were all predicated on the fact that the power in general, that the power of each buyer was approximately equal to the power of each seller. Now, 400 years ago, when the Japanese rice traders created Japanese candlesticks, that was very important that in general, every buyer and every seller contributed an equal amount of power to the direction of price. I'd say maybe into the 1960s and 70s, institutional money didn't play a major role, and this still was in general true. Now Elliott wave and Gann theory are basically telling us that in a closed system, there's an intrinsic wave pattern that we can determine with a mathematical equation. And I believe that to be true as well. But the problem is that institutional money destroys it. That if you're in wave 2 or 3 in Elliott wave and institutions start to buy or sell, they're going to destroy that wave pattern. If you're looking at an engulfing candle on Japanese candlestick patterns, or you're looking at a shooting star or whatever, institutional money will destroy it. Same with Gann theory. And you and I, we all know that a market can stay overbought, not just for minutes, but for hours, for weeks, and for months. So any divergence signal that you try to take is essentially trading against the direction of institutional money. I mean, I think the S&P, depending upon the time frame you look at, It's probably been overbought for a long time. I mean, it just hit, I think the Dow just hit its all-time high. So you cannot trade a divergent signal. All that you can do is trade in the direction of the multi-time frame trend and in the direction of the correlative markets, which are proxies of money flow, and telling you which direction institutions are taking this instrument. Order flow, which measures buy-sell pressure, is also a proxy for institutional money. When you have so much selling pressure that this candle is haloed in magenta, it's almost, the price is almost always going to fall. Now you can see that order flow is a leading indicator. Do you see how the bottom candle is blue? Now it's still moving down, but order flow has shifted long, and up you go. It happens all the time. Price is still moving down, but your last two candles, order flow now shifts and shows you there's significant buying pressure, and it triggers a move up. So in many instances, order flow, the top candle, order flow is haloed to the downside, telling you that there's significant selling pressure. So it's a retrospective analysis, because you can see that selling pressure kicked in here. And and in the master class, I'm going to tell you why this occurred. It has to do with the aggressiveness of the buyers and the sellers. But the tops, the real tops, are often called in advance by order flow. Same here. So you can see these lead the market. Background bias leads the market, and these correlative assessments of the Dow, Russell, and E-mini, looking at their multi-time frame trend, all lead price. Now, getting back to momentum, we do not want to use an oscillator that is hunting for divergence, because we don't care about divergence. What we're looking for is an oscillator that tracks the momentum, and we can step in right behind it. And that's the Laguerre oscillator. So what we do is we look at the multi-time frame assessment of the Laguerre, and that is right here. It's this line, and it's this line. Now I just want to talk for a second about the oscillator and about momentum. I mean, I have this on a slide, but I didn't want to take this webinar on the slides, because I think it sort of breaks everything up so much that it's then hard to put together at the end and for you to see how the markets move. Now, in momentum, and let me find a good example for you. Okay, here's a good example. Now, momentum measures price acceleration or deceleration. It's a second order derivation. Speed is first order. Change in speed is second order. So if price accelerates up to here, momentum is going to rise as price rises. This is the long-term assessment of momentum. And it's telling you that on the higher time frames, price is accelerating to the upside. Now, back in the old days, if price on a higher high didn't accelerate up even more, you would get divergence. And you would look for price to collapse. And maybe it would, maybe it wouldn't. But you're never going to know when it will, and you're never going to know when it won't. And you're going to take lots of losers. So really what we're looking at here is price accelerating to the upside and accelerating to the downside. And all the equation does is look at the difference between the close of the candle and the low of the candle on a short, and the close of the candle and the high of the candle on a long. And the close should approach the high, and that's acceleration to the upside. Or the close should approach the low. That's acceleration to the downside. And we look for that acceleration. Here's the only time that the analysis off your trading chart is important, is we need momentum on the trading chart. And you can see that black line heading up right here. So, and we actually have an arrow that shows you when momentum comes off oversold, crosses the 20 line, you get this green arrow showing you there's a momentum shift on your chart to the upside. But to take a long trade, you need the long-term time frame, multi-time frame assessment, green as well. So a perfect trade is going to be something like this. Both correlative assessments, E-mini Russell and Dow, and the momentum assessment, multi-time frame, is accelerating to the upside, and the candle is haloed in blue. And up you go. That's your perfect trade. Dual quants, we call it, and dual gears. This is the lowest risk, potentially highest reward trade that you're going to get. And if you wait for this setup, you're very rarely going to pull in a loser. Now, there's no guarantee on any trade. I took a couple of trades today that didn't make it. But in general, this is a very, very low risk trade. It's the same thing to the downside. Right here, you don't have a trade. You don't have the long term. So you miss a winner, but you can't care about that, because here is your perfect trade. Your entry right here. Dual gears, dual quants, and this is still a strong down color. And as the trade evolves, go all the way down. You're just looking for very low risk entries. On the roll back to the downside, no way. Correlative markets are not with you. Momentum isn't with you. Can't take that trade. This is where you get your trade, and this is where you get your enormous winner. And this is a huge trade. 23 points. So you wait for the market to come to you before you take a trade. Now, there's a few more things I want to describe on the chart, which are very helpful. One of them is, now this displays the open price here. That's the market open. This displays, this is the, if I squeeze it, it's somewhere here. Of course, I can't find it. It's somewhere here. I mean, this is the easy stuff, because these are just lines that are created. Right here. See that dash dot? That's yesterday's close. And we've just perfected a tool that's incredibly powerful. And the one thing that you want to look for in price action market structure is areas of consolidation. Now, why are they so important? And you can see this is all software created. And what it does is define a narrow channel. And in this channel, you've caught sellers and buyers. And they're all in here sweating it out. Because if the market goes up, it's going to stop out all the sellers. And if the market goes down, it's going to stop out all the buyers. So a move out of a channel is usually a very powerful one, because it's not only moved out of the channel, in our case by institutional money, it's moved out because you've caught all the buyers in the wrong direction. Now you need a 2/3 candle close above the channel line to take an entry. And your entry is right here. Dual dots, dual quants, long-term Laguerre, locked green, short Laguerre heading up, and you get a nice win. This is a very, very nice trade. And it's pushed up, not only because you're trading in the direction of money, of the big money, but you're stopping out an enormous number of traders caught short here. So they have to buy their contracts back to get out of their position, and they're going to help move this trade up for you. And that's a 6.5 point move. It's a very nice move. Now the yellow line is the volume weighted average price, is the VWAP. Just like you have an average price going back 50 periods on the 50 period, this does a long look back for the average volume on candle close. And I can't remember the look back period, but it's a long look back period. And they act as strong areas of support and resistance. Now, we're getting close to the end. With a little bit of chart time, it really does become easy and very intuitive to trade. But what I wanted to do was show you the pivots. Now, most software packages create pivots in the wrong. Now, just as an aside, I just wanted you to know that the best, now I don't trade tops and bottoms ever, but the best way to look for a top is a trade out of consolidation when the market has moved appreciably long, because it shows that in a channel, the power of the buyers and the power of the sellers is the same. You've got traders short, traders long, but neither the bulls nor the bears can break out of this narrow area here. And if it breaks to the short side, you're likely to get a nice counter trend move. I just don't trade counter trend trades because I make really good money just trading the trend. But this, I think, is the best way to leverage a counter trend trade. It's out of consolidation because you've caught so many traders long here. Now back to the pivots, because what I'm doing is giving you trading methodology that you're going to get in the masterclass. Now, most software creates the pivot at the wick high. And I can tell you that Japanese candlestick dogma does not want you to create a wick here. A pivot. The pivot is created at the candle body high. And it's easy, and it's the lazy way to do it is for the indicator just to take the price high. Here, you'd have a pivot here. And you can see there's a huge difference in where this pivot is placed. Now, I just want to show you how important this VWAP is. Price comes down to it and bounces. Price comes down to it and bounces. Price comes down to it, finally breaks it right here. But you've got to wait for the break to take the trade. Now, it's the same with the pivot. Now, these pivots are placed perfectly, and you cannot trade into them ever. We never do anymore. And I'll give you a good example. And a good example might be today, where price was so constrained. But pivots are really dangerous and they increase risk. And we don't want to trade into them. And you know, anytime I look for something, I can't find it. Needless to say, here's the rule we use for trading into a pivot. And it's the correct way to trade. I mean, here's one example. Price comes up, hits the pivot, and the pivot turns price. If you would have taken a short trade, now there is no short setup, but if you did, it would have stopped you right out. Now, the only time a pivot is honestly broken, and the only time our indicator will stop tracing out a pivot, is when you get a 2/3 candle body close above or below. See this little piece of this candle body below it does nothing. These buyers are all still here. And when price comes back down, those buyers push it right back up. 2/3 of this candle body has to snap this pivot. And we take trades that are called pivot breakers. And I'll show you an example. They're really powerful. And the reason they're so powerful is because when they snap, here's an example. Now, it's not a trade because we don't have both quants and we don't have the long-term Laguerre. I'm just using this as an example how this trade succeeded without them, because when you get a 2/3 candle close, you're stopping out all the buyers in this pivot. And when you do that, it helps propel the trade to the downside. Every time we take a trade, we want to leverage traders caught in the counter trend direction and run them over. That's the whole principle of an engulfing candle. An engulfing candle runs over all the traders in the previous candle. I just have less faith in Japanese candlestick patterns now because institutional money drives the market. But we still use that same principle. We look for a pullback or a wick and an entry long. Now we only have one system generated signal, and it's really a good one. You can't take the signal blindly, but you see this line right here? This is called the continuation signal. It's a system generated entry. And you can see it called this trade perfectly. And what it is, we never do anything off of one time frame. It's a multi-time frame assessment of range, because range and Unirenko are very similar. So if you look at the continuation signal, it's looking at an 8 range and an 11 range. And when the 8 range and 11 range align with the 4 Unirenko, you get this signal. And it's a real powerful entry signal. You still have to have the dual quants. You still have to have both Laguerres. You still have to have the pink background. And this is a great trade because it's trading off a dual resistance. Resistance of the VWAP and the 15. Break the pivot and bam, what a great trade you have there. So it's a really good signal. It's right here. It's a snap of the pivot and it's a move up. And that's a winner. We look for 10 ticks. That goes 10. Each candle is 4 ticks. So that's the system generated entry. You should look out for it because vet it, make sure you've got what you need below, make sure you've got the right background color. But when you see it, pay close attention to the entry and you will see an intra-candle. So that's really the system in a nutshell. Now, I couldn't trade yesterday, and because I had to go to Tallahassee, and I'll just show you. Now, here's our summary month to date. We're up $2,205 in the trading room. We're trading at 75%. And I always show this after every session. So if you took every trade I took, you'd be up $2,200. It doesn't subtract commissions. You'd have to subtract your commissions. We're looking to make $1,000 a week on either two contracts or 3, depending upon the trade, and to clear $4,000 a month after commissions on a very tiny account. I mean, I could trade 10 contracts, but on crude I trade 2, on the NASDAQ I trade 3, and I'll show you that I trade the Russell, and today the Russell gave us, this was the entry, and everything I needed. Now, I got 17 because I took it off at resistance, but it just blew right through, and the Russell wound up going up. And I didn't get the whole move, 33 ticks. And then I took these 2 trades. Again, pivot breaker. I've got 1 dot. I've got both Laguerres. I've got my quant. I've got my green background. I've got my order flow. This one went 11, took me out. I got a pullback. I went right back in and went up another 13. I had 3 winners on the Russell today. This one was your perfect trade. And it allowed me to stay away from every potential loser. If I didn't have background, I didn't even look at the trade. I don't want to see it. I mean, you may get a big move down, but price in general is unpredictable. The risk here is too high, and this could go 2 candles in reverse. These are your retrospective calls, but on the right edge of the chart, when you want to know with incredible precision what direction price is going to move, and there's no background color, you're simply going to stand aside and not take the trade. On this trade, on the right edge, I was very confident price was going to rise. And it did. Now today, there was a little bit of a problem with correlative markets because the Russell was much stronger than the E-mini and the NASDAQ. So you see we only got 1 dot here and not 2. And every now and then that happens. One of the index equities will show much more relative strength than the others. It's easy to see, and you'll just take 1 dot instead of 2 dots. But you need this line. You need the green, and you need the Laguerre on both time frames. And look at the Laguerre here. It was sitting at 100 and locked long. Who could lock it long like that and push it up to the 100 line and keep it there except institutional money? Small commercial traders like you and I cannot do that. So that's what made that trade just really such a great trade. So in essence, that's our platform. And we're looking to leverage institutional money, its direction, trade in the direction of that trend. And we are looking to always, on every entry, run over traders caught in the counter trend direction. That's why the break of the pivot, where all these traders are sitting to push the market short, that's why that pivot breaker is so good. And I'll tell you, a lot of those pivot breakers, they snap and the market just rockets through the pivot on that 2/3 break of the candle. It just fires out. Now, I trade this live. You saw we're up. You saw the amount of money we're up. I go through that every single day in the room. I get no disappearing winners, no disappearing losers. Everything is totally transparent. I'll show you the offer. If you come aboard, you're going to get a really nice master class session with me. I'm going to go over all the nuance. I'm going to teach you the difference between the different background colors. You'll also notice the dots have different colors. Teach you what those are, and I'm going to show you how we look for an entry. Now, I don't know of any other system that does this, but if you notice, this is a Unorenco candle. Standard Unorenco does not show you the internal wick. We made these. Excuse me one. Okay, so our system shows you the wick inside the candle body. Nothing is hidden. On most all Renko, and in most Unorenco, you can't see this wick. But we want to take a pullback, and sometimes the wick isn't big enough to come out through the bottom of the candle. But we get to see the power of the bulls and the power of the bears by looking inside the candle and looking at the size of the wick. Now, if this was a perfect trade down, you'd have to take the trade here, because here's your pullback. And this is really, I'm talking about trading methodology, but I want you to see how great the fact that you can see this internal wick come all the way back to the top of the candle body to allow you to take the trade short. Even though there's no trade here, there are other instances where there are trades and we look for the pullback. We just can't dive into a trade just in the middle of it like this. There's no guarantee it will continue. We need a pullback, and that hybrid Unorenco candle does it. We made them here. I have a lot of traders in the room who have said in the course of their trading career, they've seen them before. So I don't believe we're the first people who have ever made them, but I don't see them around at all anywhere except with us. And it comes as part of the platform. Now, there's the Russell, there's the NASDAQ, there's crude. We've got templates for gold, for bonds, for notes. Every market needs its own template because each one has a different set of correlative markets, has a different speed of the correlative markets, has a different speed of background bias, has a different speed of the multi-time frame Laguerre. So we give you those templates. And if there's a market that you trade that we don't have a template for, we'll make it for you. Like we don't have soybeans, wheat, corn. If you trade the agricultures, we'll make them for you. So I'm just going to open up the slides and show you the offer. Now, see, here's the offer. The regular price is $29.99. The special offer is $13.99. It's everything. And you get templates for Crude, Mini, Dow, Russell, NASDAQ, Gold, DAX, 6B, 6E, 6J, 6C, bonds, notes. Now, normally we charge for these templates. You're going to get a 10 module educational series on video, video. You're going to get access to our video tutorial library, 450 videos. You're going to be in the live trading room with me for a month for free. And I'm telling you, that's going to really accelerate your learning curve, because most days I make money. I don't make money every day, but I'd say I make money 8 to 9 days out of 10. You're going to see exactly how I trade and look over my shoulder and critique how I do. We do all the installation and support. And we're always upgrading the platform. And in fact, we have 2 indicators that we're going to be adding that are killer indicators. We just added the consolidation indicator, and we also are going to be adding something really special. It's a volume analysis that's really just very different from anything else you've ever seen. So you get all those upgrades and add-ons for free. We never charge you for any additional indicator we create. And we do all of the installation for you, and tech support. If something if you have a problem, you call us, we fix it. And the first 5 orders, you're going to get a one-on-one session with me. And if you can't assimilate all the data in one session, I'll do 2 with you. I want to get you to the point where you can trade this platform really well, follow me in the trading room, and over my shoulder and piggybacking off my trades. Obviously, you're going to be on sim. You're going to be learning everything. Get you to the point where you can, after your educational process is over, you're going to be an independent, professional trader that can consistently make money week in, week out. You'll never make money every day, but all that matters is you make money every week, or almost every week, and you make money every month, and you're going to set your profit goals. So the offer ends on the 15th, which I believe is Sunday. You can call us right here. I'll leave that up, and I'll answer any questions that you have. So hang on one second. I have to find the questions. So here they are. Okay. Hey, Mark. No, Muhammad, this is live. This is no recording. I'm right here. And those calls from my son would never be in a recorded webinar. So, okay, well, listen, I appreciate everybody giving me your time. If you have any questions, you're welcome to call us at 732-4656. If there's any additional information that you'd like, and I really appreciate you giving me your time. My goal is to make you a profitable trader. I'm going to work with you until we get there. All you have to have is patience and discipline, and the platform will do it for you. So take care, everybody, and have a really, really wonderful weekend. Bye-bye.